Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Beiley, founding partner at Steward Partners Global Advisory, to discuss what the election outcome means for investors in the long term and where the opportunities and risks lie. Eric, it's great to see you. Welcome to Trade Talks.
Hi, Jill. Thanks for having me.
And regardless of election results, you recommend finding a balance of growth and advising clients to ride out the election or other major volatility events before making big changes. Explain the strategy and why a long-term outlook is key to the overall plan.
Sure. 2020 is a perfect example. Trying to trade around or make investments around huge events is very difficult. And this year is a perfect example. We were going into March and April in a pretty good market economic climate, and all of a sudden COVID hits, and clients we work with, all of a sudden the markets are down 35%. And there's a lot of nervousness, a lot of apprehension among clients. And then you fast forward just a few months from there, and we're almost back to break even. And then as we get into the summer, the markets are positive. And today is another perfect example as this election, which has been so polarizing and so has made clients so nervous. The S&P 500 today is up 7% for the year. And so our strategy, our focus with clients is always to have a long-term view, to have a balance in your investments, and to ride through these difficult, challenging periods.
Yeah, it's really quite remarkable, the market action this year and how it has come back so strong. And you also mentioned that lack of stimulus has added to some of the uncertainty that we're seeing. Combine that with COVID and the election. You would think that markets would react negatively, but the biggest issue longer term seems to be facing the financial markets. Once the election is over, the markets will continue to fluctuate. Biden supporters will start selling their stocks, a Trump win, and vice versa. So how does that fit into the longer term strategy? I think it goes back to what you were saying before. You have to ride these blips throughout the market. It's just normal market machinations.
Yeah, stimulus is a perfect example, right? The last couple of weeks, it's been stimulus, and the markets have been volatile at reacting. As it looked like a deal was going to happen, the markets liked it. They went up, and then politics and the election got in the way, and stimulus got delayed, and we had a very difficult, really 2 weeks. Last week was a very difficult week for the markets, not very good, and now, surprisingly, as we're in this election today, as they're counting votes, we have this huge market rally, right? The markets today are kind of happy so far with what they're seeing with the results. That, in my view, that it's not this Democratic sweep. And the markets like the fact that it's going to be more of a balanced government, and that's positive for the markets. And so from an investor standpoint, if you tried to trade around this, or your emotions got in the way and you were supporting Trump or supporting Biden and felt if your candidate didn't win that we were going to have serious economic reaction, and you decided to sell, you're not happy today because of this increase. And so
yeah.
So over and over again, it's been proven not to trade events. And, I go back, I've been working with clients for over 20 years, and there were events that at the time seemed like the most important event in the world. Y2K, 9/11, obviously the crash of 08 into 09. And today we have COVID. And so for people who rode through those, even though it was very difficult, investors, they've been rewarded clearly in their portfolios.
Yes, and it reminds me what you were saying before, how the market has been so sensitive to stimulus headlines. We're going to get one. Pelosi and Mnuchin are close. You see these headlines back and forth all the time, with the exception of the last couple of weeks. But it was almost like that in the fourth quarter of 2018, where the market was reacting the same off of, are we going to have a China trade deal, phase 1, phase 2? It's the same thing, just a different headline.
It is. The most important thing is for people to manage risk in their investments, and that they can handle the risks that their investments have. Too many people will be overweight. Right now, it's very easy to be overweight just these technology stocks and the growth companies because of how well they've performed. But with that comes a lot of volatility and a lot of downswings that can be very severe. And you have to be able to stomach that those downturns and that risk. If you can't, you need to have more balance, lower risk, portfolios. And that's how, that's what we really strive to provide our clients, is risk adjusted portfolios.
So Eric, let's talk about that and get out of the equity market for a moment. Where are you seeing opportunities with fixed income, some other tax advantage type investment, alternative investments?
Sure. Fixed income is challenging. Obviously, as the Fed has lowered rates to near zero to stimulate the economy as COVID, the downside there is investors, or people who want a fixed rate of income, whether it's from money markets, savings accounts, or bonds. It's challenging because now the returns on those bonds is a lot lower. The cash flow they're receiving in new bonds is a lot lower. But we still recommend an allocation to fixed income. So we like, especially now as taxes are a big issue, we certainly like, for higher net worth clients in higher tax brackets, municipal bonds, as they provide a tax-free income. There are other qualified fixed income instruments like preferred shares that we like. We like certain cash short duration instruments is also. And then for higher risk clients, we like certain funds, closed end funds that provide higher returns, but they have higher volatility. And then you mentioned alternatives. Sure, we always have, for those clients who have a longer term view, whether it's private equity or single manager alternatives. Recently, we've been allocating a few to real estate in the residential space. Companies now have been buying large numbers of single family homes and renting those out. And all of that income from that rent goes back to these investors. And that's proven to be a very attractive asset class.
All right, and to wrap up here, what's your view on value? I feel like we've been talking about the value versus growth trade for so long, and it just has not gained any traction.
You're right. So I just went through the numbers today, as in anticipation of talking with you. And so the spread right now between the Russell 1000 growth, which is up 27% right now, and the Russell 1000 value, which is down 11%, is 38%. So a lot of people have always felt, I need value, I need dividend stocks, and they are rewarded for that. But this year clearly has not been the case. The last few weeks has been interesting. Value has actually outperformed growth. You've seen industrials, financials, even energy, which are the classic value sectors, perform well. But then look at today, and as the markets are kind of reacting to the potential election results, you're seeing vice versa. You're seeing growth and technology do well. We reiterate long-term a balance, that you have to have allocations to both growth and value to balance out the risk. We do feel that these value stocks, eventually COVID will move on. And our belief is that when the economy opens up more, these value sectors, financials, energy, industrials, are going to perform better. It's not going to be all about Zoom and these stay-at-home type investments that have done so well this year.
All right, Eric, appreciate the insight. Thanks for joining us on Trade Talks.
Sure. Thanks, Jill.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.